So what does it all mean for the retailers who are under pressure from consumers who suddenly prefer saving to spending and now face the prospect of higher interest rates to stamp out inflation? There's been a slew of profit downgrades and store closures across the sector in recent weeks, and things could get a whole lot worse. Neil Woolrich reports.
This bookstore might be bustling now, but ask anyone in the trade and the past year has made for grim reading.
Probably if you take Amazon and Book Depository together, they're probably the biggest bookseller in Australia in turnover. So they are having a dramatic impact, as well as the soft retail conditions. Those two combined are sort of almost have been like a perfect storm.
Mark Rubo runs Readings Books, a chain of 6 stores in Melbourne's inner suburbs. Readings has weathered the storm when others have failed, most notably the Red Group, which owned Borders and Angus and Robertson, but went into administration in February.
We've found the last probably 12 months very, very difficult, but since the Red Group did fail, we've noticed quite a big lift in sales. Perhaps it had to happen that the Australian market had too many book retailers participating in it.
And it's not just booksellers who are feeling the pinch. This week, Premier Investments, which owns Just Jeans, Portmans and JJ's among others, slashed its profit forecast and announced that 50 stores will close. It follows downgrades from David Jones and Myer. All 3 retailers are expecting this year's profits to be lower than last year. And now official figures confirm that retail sales across Australia are flatlining.
It's no wonder that people are talking about consumer caution. It's no wonder that retailers find this very tough indeed. Coming after a period where real per capita spending had been rising by 2.8% a year for 10 years, no net growth over 3 years is quite a change.
You see it in business surveys that we run where the retail sector is producing the same results as the bottom of the GFC. So at the current level in June was basically the same level as November 2008.
And that's leading to what seems to be a never-ending cycle of discounting. But while retailers bemoan the ongoing consumer thrift, this week's inflation figures tell a different story. The data shows robust price increases for a range of discretionary items like furniture, clothing and household appliances.
When we generally look at retail pricing in surveys that we run, we see very, very little increases in prices. Now, the statistician has gone out and recorded it and said they've gone up, so they've gone up. But to the extent they've gone up in a weak environment, you would expect then a significant round of discounting to be actually happening now.
We've always had some books on special to try and give. We've never gone with deep discounting. We're a full-service shop. We, very high overhead, so we've got to pay for those. But we do try to source good deals for our customers where we can.
And it seems in these straitened times, not all retailers are created equal. One of Australia's biggest property managers, Colonial First State, is reporting a mixed bag of results for its tenants. Over the past 12 months, supermarkets and specialty retailers have reported solid sales growth, but shoppers are deserting department stores. Another area that is flourishing is rental.
We will do well at any time, but particularly when things are uncertain.
John Hughes is Chief Executive of the Thorn Group, which owns Radio Rentals. He says the rising cost of living and high levels of underemployment, which are hidden in the official statistics, are also significant factors in the retail malaise. But he argues some retailers are also to blame.
If you don't reinvent yourself, then you're going to lose market and you're going to lose the loyalty of consumers. And I think there's a lot of retailers today that haven't abided by that, and they haven't reinvented their offering, their stores or anything out there to consumer land, so they're not creating that style of newness and innovation that is required in retail.
The prospect of rising interest rates is often given as a reason for the lack of consumer confidence, and the threat level was raised several notches this week after a higher than expected inflation reading. But the Reserve Bank Governor argues the elevated savings ratio does have its benefits.
We're actually building resilience into the balance sheets of our households pretty smartly right now, and I think that's a thing which will stand us in good stead, particularly if there are troubled times at some point in the future.
Even if the savings ratio just levels off at its current high rate, then income will continue to grow at 4%, and that means basically consumption will start to pick up. But that might be 6 months or so down the track.
But that in itself won't be enough to kickstart a fragile economy, which has already reported a large drop in activity in the March quarter.
The role of the household sector in driving demand forward in the future upswing won't be the same as it was in the preceding period.
And we'll learn this week whether that will force the Reserve Bank to lower its forecast of above-average economic growth in the year ahead.